right, good afternoon, folks. Today is Tuesday, January 14th, 2025. I am an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure. I guess the new thing here from when I last broadcast an afternoon meeting is not only am I not short these quantum computing stocks, I'm actually long the quantum computing stocks. With that said, I don't have a lot left, and I took off even more into the close. So I've got very little QUBT and RGTI left after today's bounce back. It covered most of what I was looking for, and I wouldn't say that I'm trading it conservatively, but I'm having a very conservative target on the bounce. So I'm trading it aggressively, but I'm very quickly piecing out here as time goes by and those things don't bounce. But let's start at the index level like we always do. So SPY's here up 0.3%, Q's up 0.2%, IWM 1.4%. Very impressive. Looks like we're up a little bit after hours. That includes after hours action here. RSP up 0.8%, on the day. It was a breath day. Equal weight outperformed. Doesn't happen too often. Part of me thinks it could potentially become a theme, though, in 2025. So we'll see if that happens. There's a good chance, I think, that some of the policies that are coming from the incoming administration may benefit more of an equal weight portfolio in conjunction with a little bit concerned about the earnings reports from these Mag 7 companies this earnings season, but we'll see. I've been concerned about them in the past, and there tends to not really be too much of a reason to ever really be concerned about how the Mag 7 companies are going to report. It almost always seems like it's pretty good. Well, let's take a look at our daily chart technicals here. So we had some relief from the market today. And if anything, I would almost be surprised if the market's not higher. But again, the equal weighted performed pretty well today. So if you look at the IWM and you look at the RSP, it was a really good bounce back day. This IWM recaptured the support level that it lost. The RSP right back into the midpoint of this bear flag range that it had been in and had broken down. You could even make an argument when you look at RSP right now that it was a failed breakout to the downside, which then could potentially break us up on the upside. So we will see, obviously, if that happens or not. Do I feel the same way about the IWM? Let me look. Yeah, IWM get me back to like 222, 221 to 222, and it'll look a little bit more like a failed breakout to me in the breakdown in the IWM as well. For the moment, this is just a bounce back to a declining ADMA. So we'll see if bears regain control. Obviously, a lot of that is going to depend on CPI. So to recap a little bit, what I said in the morning meeting today was that it seems to me that the bulls have every reason to try to push this market higher today when we think about kind of our fundamentals, our qualitative fundamentals on this market, the evolving story. If anybody heard me on Benzinga this morning, I talked about three main areas of risk for this market right now. One is uncertainty around the administration, the incoming administration, particularly around how they are going to impose the widely discussed tariffs. Two is the Mag 7 earnings, which we're still a little bit a ways from. That'll be end of January, beginning of February. Particularly if, and this has been an ongoing theme for several quarters now, if the AI spend is not justified by the AI revenue that's coming from the Mag 7 companies. And then finally is just the broader tightening conditions that this market's been battling when it comes to interest rates moving higher and the dollar moving higher. We got some solid relief on a couple of those key areas this morning, namely chatter that came out of the incoming administration that tariffs may be put in incrementally and not all at once. So the market that came out after hours yesterday, the market loved it. The futures were up after hours really, really solidly on that. And secondly, we had a also kind of off that we had a pullback in the dollar, and then to add on to that, we had a PPI, not as important as the CPI, but we had a PPI that came in light this morning. So it really, I think, gave some relief on the risk of these, as I'm identifying them, three more major macro risks for this market. So we had every reason for bulls to step in and try to get us back above the levels that we lost, namely 580 in the SPYs. We did that. 218 in the IWM. We did that. And 510 in the Qs, and we did not do that. We tested that 510. I want to say like 3 or 4 different times if you include the pre-market price action. We never really were able to get above 510 in the Qs. And then again, Mag 7 was relatively weak again today. Semiconductors were relatively weak again. AMD's down a percentage point. NVIDIA's down nearly a percentage point. So we had some weakness there in Mag 7 that led to weakness in the NASDAQ. That made it so that the Qs are the one index that really could not recapture those levels. But while recapturing the levels for 2 of the 3 indexes is great for the bulls, they have a lot of more work to do, because a bear would make an argument that all this is a extension relief bounce back to this equilibrium zone, and that we're going to create a pivot high here and then get right back below those key levels that I just discussed and work our way lower. And that is what a downtrend would dictate if the downtrend continues. So we will see if that happens. I would just keep in mind that the downtrend, I would describe it as like smaller and intermediate time frame. The uptrend is still intact on the big time frame, as represented by the rising 200-day that you can see in the SPYs, the rising 200-day that you can see in the Qs, and a bigger picture bull would say, hey, the uptrend is still fully intact, and you know what? When we were at all-time highs and the Qs were at 540, we were just very extended from this 200-day, and just a little bit of a bigger picture pullback in this market, and it is once again a viable dip. So we'll see. We have competing trends on competing time frames. Big picture trend is higher, small picture trend is lower. When you have competing trends on different time frames, most of the time, but not always, the big time frame is what wins. If you've got a downtrending small time frame and an uptrending big time frame, most of the time what ends up happening is the small time frame reverses higher and the big time frame holds in. A lower probability situation that certainly does happen, it's how reversals happen, is that eventually the small time frame downtrend overwhelms the big time frame. But we are so far away from getting to the 200-day, getting below the 200-day, and let alone causing the 200-day to lose its upward slope and flatten out and eventually move down. That would take probably months of price action to be able to of weakness to be able to get to that point. So not easy. We'll see. So that is kind of the macro right now. Bulls did a good job holding this market in, but they need a CPI win. They need a CPI win tomorrow, and they need this VIX to come back down to the mid-teens again, and then propel this market higher, really recapture that 510 for the Qs, and give us the possibility that all of this was just a false breakdown that eventually breaks to the upside. And on the bear side of things, if you get a hot CPI and you get the VIX to pop through, I think 20, 22, and 25 are really important levels on the VIX, where if you start breaking those levels to the upside, that could create a feedback cycle of forced buying in the VIX and forced selling at the index level. So that's some of the key stuff to think about and pay attention to as we go into another important economic number. So that is the market. As far as individual stocks go, my game plan in the morning meeting today, when it came to trading the indexes or trading things that were overly correlated to the indexes, was really to be patient. I didn't feel like I had a really strong advantage here because while I just discussed that the bulls had every reason to be able to rally us higher, it is tricky to buy a market after a really strong bounce that is downtrending into declining moving averages. That's typically a low probability trade because if you're doing that, you're starting to really bet on a full reversal or at least like a much bigger bounce back within the confines of this downtrend. And oftentimes it just doesn't represent a good risk reward. Like if you're looking big picture at the index here, the SPYs, and you are thinking about buying the open at 584 and change, the technical right stop loss, at least based on the daily charts, all the way down to yesterday's low. So you'd be taking on $9 worth of risk for what? A move to the 80 EMA, $2 worth of reward, maybe a move to the 21 EMA if you get a really big retracement higher. That would give you $6 worth of reward, but that $6 worth of reward doesn't justify $9 worth of risk. So basically, I felt that if you were coming in and really buying the indexes or things that were correlated to the indexes today, it just represents a pretty poor risk reward because at that point you're basically counting on a full reversal. So I was planning on generally avoiding things that were overly correlated to the market unless I saw something that was really compelling from like a relative strength perspective. At the same time, I didn't want to rush in on the short side. I did say if you were an aggressive short, you could have tried to short versus the pre-market high after we pulled back from the PPI high. But also, like I said, from that qualitative fundamental perspective, the bulls had every reason to try to rally this market. So for me, if I'm like, I don't want to buy this market because these technicals are giving me a bad risk reward setup here, but I don't want to short this market because the qualitative fundamentals just improved in such a way that could enable this market to potentially rally today, that just leaves me with not a lot to do from like a short-term trading perspective, either at the index level or trading stocks that are overly correlated to the indexes, basically your Mag 7 stocks. I'm still getting paid by these quantum names though. Lo and behold, I find myself long them. Dealt with a little bit of pain yesterday. I started buying these a bit yesterday, this QUBT, RGTI, SOUN. So dealt with a little bit of pain yesterday. I felt like I traded them well. And then even though they closed on lows with so much extension away from the 80 EMA that I felt really confident that barring bad overnight news, that we would see a nice relief rally in them today. So I swung some, I added a bit this morning to them and caught a decent bounce in QUBT and RGTI, especially RGTI. I was able to fully liquidate this SOUN when it got to 14.25, which is basically my very shallow target that I was having on this. So that worked out pretty well for me. I ended up buying back a little bit at like 13.25 on a small non-aggressive position, which I am swinging tonight. But overall, these worked out really well for me today, especially led by this RGTI. RGTI is really bounced back to my target zone. I was looking for $10 at one point, but I was actually looking for $10.50 at one point. But as time goes by, because time I do not think is a bull's friend when it comes to these broken stocks right now, the entire idea of this trade is just a bounce back of the downside extension after 3 to 4 heavy days of selling. So I've been reducing my target a little bit each day. So first I was looking at 10.50, then this morning I was looking at 10, and then into the close I sold even more stocks that my target only becomes 9.50. So that's 9.50 with the 80 EMA at 11.60. Obviously that 80 EMA is going to come down further tomorrow, but like I said from the beginning, I'm not a believer in these things at all. It's just after selling from 21.50 to $6 in 4-ish trading sessions, a bounce back to $9 to $10, or it could be more than that. I might be robbing myself of a few bucks here, and I'm fine with that. Seems more than reasonable because that's just how markets work. Markets work and they ebb and flow over time, and we can take advantage of extension a little bit. So now at this point, I'm really just looking for a move to 950 in RGTI. It's almost there right now because this thing has bounced even a little bit further after hours. QUBT, a little bit more disappointing, but same deal. As time goes by, I just keep lowering my target. I took off more stock on this thing into the close, so now my position on this is pretty reasonable. I'm really just looking for a move now to 850 in this thing. So I'm pretty light in these compared to where I was at the open this morning and after hours yesterday. I got pretty big actually at a certain point. I got pretty big with a shallow upside price target. So that is working pretty well. These quantum stocks have been just phenomenal trading vehicles just with how big these movements have been. I don't expect that to necessarily last forever. And once I get out of these longs, there's a good chance I won't trade it for a while because I'll just be reassessing like what are the odds that I get another opportunity in the near term that is similar to the degree of upside extension or the degree of downside extension that we just saw in these things that can create a really good opportunity. It's probably unlikely. And one of the things that I've certainly learned over the course of my career, and this is actually a warning for traders who are newer to the business, is when there is a huge opportunity in something and maybe you get paid in it really well, or maybe you miss it entirely. That's the problem that new traders tend to have happen to them. And you think you're that new trader, you missed these moves, you weren't involved in it, and you're like, oh my gosh, some people totally crushed it. They made so much money in these things, and I didn't. So now I'm going to trade them, and now I'm going to make a lot of money. And you do that once it gets more difficult, and once it gets more choppy, and once the advantage is gone. So there's a good chance that once I'm out of the way on the remaining long positions I have, which I expect will be tomorrow, that I don't trade them for a while until they really reset up with a great opportunity, because you don't always get the setups like that, and it won't surprise me if I never trade them again. To be honest, it won't surprise me at all if like this RGTI fades back down to $1 to $3 into oblivion, and then it never really comes up on my radar ever again. I don't really think that's going to happen. I think that some of the excitement around this quantum stuff is going to be here to stay, and we'll see future squeezes at certain points. But there's just been so many stocks over the course of my trading career that got hot for a short period of time for whatever the fad was, and then you barely ever remember them again. They go into the history books of stock trading. So we'll see. I think that pretty much covers all I got. The quantum names continue to be a big part of what I'm doing. I'm just looking at my overall volume on the day, and between RGTI and QUBT, that's probably just those two stocks are probably 70% of my trading volume today when I'm actively trading like 20 positions. So there's just been so much movement in them. That's all that I've got. I'm happy to answer any questions anybody has. Only seeing one so far. It's from Tate. What are the chances that every tech company name drops quantum during this earnings season, causing their stocks to rally while the theme is still hot? So that's something that we see happen all the time whenever like a new hot theme comes around. Obviously, we saw that with AI. There's been other themes that are escaping me right now that when it becomes the hot theme that everybody just talks about for that period of time. I'm not sure we'll see that as much for quantum name dropping this earnings season as we did for like AI. Just because I think that quantum is a good bit more specific than AI, which every company needs to integrate. And I don't think that quantum is there at that point yet. I don't think that a lot of these companies can even attempt to say that they're involved in quantum. I'm sure that we'll hear it from Google. I'm sure Google, the term will get mentioned, but that's because Google's the one that set this whole thing off when they announced back here on December 10th, whatever that chip is called, that they developed. They set this entire thing off. So thank you, Google, for doing that. We might hear from IBM because IBM is like the OG player in the quantum space. But I don't know if we'll hear that from a lot of these other companies because I just don't really think that they're involved. But thanks for the question, Tate. An astute observation like always. Not seeing anything else in the VTF for the moment, so I'll pop over to the YouTube from Liam asking me for my thoughts on Uber. Let's have a look at Uber. Uber is trying to build out like this bullish consolidation, and I'm trying to remember what triggered this that made me think that made me get more bullish on Uber. It was some sort of partnership. Wow, it's totally escaping me right now. There was like a fundamental catalyst I thought was a positive for Uber and a negative for Tesla that came out last week, and I'm completely forgetting what it was. Oh yeah, it was Uber partnering with NVIDIA over self-driving. Yes, thank you. So that was like I thought like a really positive catalyst that gets Uber back in the game here a little bit because. Give me 1 second, I just got filled on something. Because it seemed at a certain point, and I don't overly follow Uber, but somewhere in this down move, I don't remember if it was this gap down at the end of October or if it was this heavy sell-off on this negative Mariposa that came in on December 5th. There was news that was the opposite. That basically said, like, Uber's got no chance on self-driving, and it's going to be all Tesla. And then the Uber NVIDIA news came out, and I was like, oh, well, that's interesting. It looks like Uber still has a shot. So it gave me a bull thesis on Uber. I still have that bull thesis. I do not like today's candle. I don't know why it was negative today. I don't know if there was news out on it or anything like that today that caused us to be negative. But the market was strong enough today and closed positive, and especially on a day when it was the Mag 7 that was weak and seemingly everything else that was strong, you needed Uber to go today. You want to see this Uber getting above this tail high from yesterday on a strong market day, getting above 67.20, participating with the market and fulfilling this pattern here that I would argue is a neutral to bullish pattern, but to me becomes even more bullish when I think about that catalyst of the Uber NVIDIA partnership that we are discussing. Don't love the candle from the 7th, but it's off of a lot of extension at that point after 4 up days in a row, so it's not the end of the world. More concerning to me is today's candle, and I do not want to see Uber lose 63.96, the low from 2 trading sessions ago. If it loses that on a closing basis, I think you have to take a step back on any bull thesis that you might have on Uber. And really, for confirmation now, we need this thing to get above 67.20. We need this to get above $68. So we'll keep an eye on it. Good stuff, Liam. Keep it up. Cyril just saying last trading hour in the queues today. I'm not sure if that's a question or not, but I can take a quick look at the last hour. Yeah, so the last hour, really last hour in like 10 minutes got a bit crazy here. We saw this aggressive sell-off that came in starting just before 2 o'clock. I know at that time we had a bunch of Fed speak that was coming out that seemed like it helped move the market here a little bit, and Tesla in particular really seemed like it was what was leading the market down at that time. So we got this very heavy sell-off for 15 minutes here, and when that sell-off was coming in and when we started to make this bear consolidation, I was like, oh crap, like now the SPYs are back below 580 and creating like a bear consolidation. The IWM actually held in pretty well, but maybe could pull in deep enough to lose this 218 by the close if we get continuation off of that. So it was really concerning. And then into the close, we broke up on that bearish consolidation on the 5-minute chart. I don't remember what the MOCs were. I was a little bit distracted by something. But I'm assuming that the MOCs helped because we got a really nice bounce in those last 10-15 minutes of the day to then give us a decent close where we closed above those key important levels. But for sure, the price action in the last like hour and 15 minutes of the day today was pretty wacky, as it can be, especially with those when the MOCs hit. From Giancarlo in the YouTube. Is there a particular dollar amount in terms of degrees of extension that you look for short or long using 5-minute and 15-minute charts in a $200 stock, $300 stock, $400 stock to clarify extension from the ADMA. No, there is not a particular dollar amount when it comes to looking at particular stocks on those time frames because every stock has its own unique characteristics insofar as momentum and beta and things like that. Looking at extension on a 5-minute chart in a super in play stock like an RGTI versus looking at extension on a 5-minute chart in Procter and Gamble versus Apple versus the indexes, it's going to be all different. Even if you assume that every one of those stocks trades at the same price, $200, let's just say, if Apple, Procter and Gamble, RGTI, and the SPYs were all $200 stocks or ETFs, there would still be no rule that I would have that covers all of those because you can't compare how a Procter and Gamble trades versus how an RGTI trades, to use more specific examples, more extreme examples, I guess I should say. So I feel like I'm fairly dialed in, and I still can't give you a dollar amount. I kind of more eyeball it a little bit. I feel like I'm fairly dialed in. God, and I hate applying anything to feel. It feels so bad. I really should have dollar numbers when it comes to the SPYs and Qs on 5-minute charts and 15-minute charts that I feel like are important. I don't, and I only have it on the daily chart. And I guess to some degree I don't on these small time frames for the indexes because is that extension coming from a gap? Is it extension coming from news? Like that impacts it. As I say that out loud, I know it impacts on the daily chart also. But I don't. I feel like I've got a good feel on the index level. The thing about these indexes is, sure, there can be news that can enable extension to become even more extended at the index level. But considering that it is a conglomerate of 500 stocks, as an example with the S&P, it's really hard for like extreme extension to last for very long periods of time at the index level. It has to get satisfied. Whereas when you're looking at a stock like a low floater that's squeezing up on the upside, that's an entirely different ball game on the degree of momentum and short squeeze and extension that can come off that from an individual stock. So I don't really have direct rules that I can tell you that govern it to answer your question. I would say that you have to understand the stock that you're trading. Like when it comes to this RGTI, for me to consider going long RGTI, which is a stock I really don't believe in, for me to consider going long this thing, like I need to see like the extension at lows yesterday. The stock was trading at 6 and the ADMA is at $12.40. You have a 50% discount on where the stock is trading to the ADMA. That's insane. And on a day 4 to the downside. So that was like such an extreme amount of extension on that daily chart where it's like, all right, I understand that this stock is a momentum stock. I understand that this thing could crater to 5 and get even more extended. But there's going to have to be some degree of sideways action or bounce back that comes into this thing at some point, probably relatively soon. And for me, for the way that I trade, for the way that I manage positions, the way that I game plan this position in particular, I'll make money even if they just go sideways and correct through time, and then I'll liquidate the position because it was a time correction. I'll make even more if I can get the price correction that I started to get in RGTI, but I'll make money if it bounces. I'll make money if it goes sideways. I'll make money even if it goes down, as long as the rate of volatility intraday, which has been huge on this, exceeds the amount in which it goes down as I enter the position, basically. So I hope that helps to answer your question, because it's very specific to the circumstance and the stock that you're involved in. And I wish that there was a very firm rule of, hey, on this $200 stock, when it's down, or any stock when it's down 10% from its ADMA, that means that you have a very high probability of success coming in on the other side. And I don't necessarily think that that's true. Tate saying for the indexes, I assume you mean the spies and the Qs in particular, $2 in the 5 minute and $3 to $4 in the 15 minute for what it's worth as that extreme extension to be able to come on the other side. Okay, thanks Tate. Appreciate that. Appreciate you paying attention to that. All right. No problem, Giancarlo. Anything else, guys? I think we might have a few guests in here from the Benzinga this morning. If there's any guests, feel free to ask any questions at all on literally anything. I am happy to answer them. I do have to drive an hour and 20 minutes to Idaho Falls when I get out of here again to go and pick up my car that I had to drop off yesterday, but I'm in no real rush to get out of here. But now, RGTI just had a big drop. From Jim. Adding to that question, I had 2 stop outs today, Tesla and NVIDIA. I was looking for extreme extension on the 15 minute. I was looking for extreme extension on the 15 minute ADMA and a potential higher low on the daily. They never bounced. This is typically a playbook trade, but this was the 3rd stop out this year for me on it. How do you distinguish a bounce from an extension time correction? Sure. And I assume maybe you're talking about this move here where it got like pretty extremely extended to the downside, and maybe you're coming in and you're trying to buy Tesla and NVIDIA. And I think I remember you commenting just that Tesla was so heavy, and this did not bounce back in the same way that the index did, unfortunately, because that's the one that you were involved in. When I take that type of trade, and I've been doing it a lot more, and I've been having a lot of success with it. When I take that type of trade, I have absolutely no idea whether or not it's going to be a price or time correction. I just know that a correction through time or price is very likely. Which one will come, I genuinely do not know. So the way that I trade a lot of stuff right now when I'm doing this, and as discussed, this approach is not necessarily right for everybody. It works for me. Is that if I started buying, I don't know, I'll just use this Tesla as an example. Let's say I started buying at 401 in Tesla. I'm going to have some degree of increments of buying and selling. So let's say I bought on the 3rd 5 minute bar at 401. At that time, the ADMA is at 406.50. I know it's rapidly moving lower, so I'm not going to buy 401 with an expectation that it's going to, even on a perfect price correction, get back to 406.50. I'm going to buy this assuming that it's going to work its way lower. And if I'm buying 401, I'm going to assume that the ideal price correction that I'm going to get is going to be a bounce back to 404. That's probably initially where my head comes in. Now what I'm going to do is I am going to, let's say I buy 401, and let's say that I'm planning on selling every 50 cents on the way up. So just to keep it simple, if I buy 401 and I'm looking for a move to 404, that's a $3 move. So if I'm going to sell every 50 cents, that means that I need to have basically 6 units of stock to sell. So that could be 100 shares each. So maybe I'm buying 600 shares at 401. So then I buy that 600 shares with 401. I offer out 401.50, 402, 402.50, 403, etc. on the way up there. But then I also, and this is where it becomes tricky and difficult, but this approach works for me, but this will not work for a smaller trader with a smaller account. I just want to be blunt on that. This is a way that you could blow your account to smithereens, as a matter of fact, if you're trying to do this as a smaller trader with a smaller account. What I'm also going to do when I buy that 401 for those 6 units at 600 shares is I'm going to put another bid at 450, another bid at 400, another bid at 395, 50, 399, etc., all the way down. And I will do that with the plan of I am going to basically work those 50-cent increments until the stock touches the ADMA. So what I'll do when the time correction comes in, it like this, and this is a great example because it's probably like one of the worser case. No, worse is not a word, but I'm using worser, not worst, because there could be worse examples. But this is probably one of the more worse um, examples that could happen just from a P&L perspective on how the trade itself actually works, because this thing was an absolute dog and did not bounce at all, traded lower and then eventually time corrected a little bit. So what I'm gonna do here, like I said, is now I have those offers out, now I have those bids out, and I will just work the 50 cents. So it keeps going down. I get filled at 450, I offer 401. I get filled at 400, I offer at 450. I get filled at 395, 399.50, I offered at 400. I get filled at 399, I offered at 399.50, etc. But what I also am doing at the same time is once the ADMA, because it's time correcting, gets below 404, I reduce my upper offers down to keep them below the ADMA. So originally I'm thinking, all right, best case scenario, I can get a move to 404. I've got that 8 units to sell, sorry, that 6 units to sell for a move up there. And now when I get to the 1510 candle here, the ADMA is at 320. Is at 403.20. So I no longer am going to have a 404 offer. I'm no longer going to have a 403.50 offer. I will be reducing them. I'm just going to say for simplicity's sake to the ADMA, which means that now my 400 offer, I'm taking that 400 offer for 100 shares, 404 offer I mean, and that 403 offer for 100 shares, and I'm putting them both at 403.20. In practice, I go below the moving average. I choose an amount that's somewhat arbitrary based on the price of the stock in which I'll be in front of the ADMA. I don't want to sit exactly on the ADMA and rely on a perfect touch. I want to be a little bit in front of that ADMA because the ADMA is continuing to decline. So really, I wouldn't go 403.20 for those two pieces. I might go 403 and keep like a 20 cent below the ADMA kind of ride down. Now the next 5-minute bar comes along. Note, by the way, on the 1510 candle, I'm now getting filled all the way down to 397 on those bids. The 1550 candle comes along here, and I get a bounce back to 399.50. So just off this candle alone, and I'm sure that there were some mini bounces within the 5-minute candles themselves for 50 cents because it's Tesla. But now just using the low and high of 5-minute bars, I got filled at 397, and I'm getting a bounce back to 399.50. So I just sold at 397.50, 398, 398.50, 399, and 399.50. So I got 5 sales there at 50 cents each. If that is, and it'd be easier for me if I was actually in this trade to be able to explain it, because I could just look at my own math on what my P&L numbers were. But if those are 100 shares, each share is going to be $50 in my pocket basically on that sale, and I just got 5. So now I just got $250 worth of sales basically in that bounce back. Obviously, I'm still underwater in the trade. And this ADMA is continuing to decline. So now by 1550, the ADMA is at 402. So now the stock that I offered at 404, 403.50, 403, 402.50, and 402, I got basically 500 shares sitting at 402 now. Which if I can still get the price correction, even at 402, I'm still going to make money. Because I started buying at 401, and if I get a move to 402, and I sell that 500 shares at 402, that's $500 in my pocket off my original 401 buy, plus all of the 50-cent incremental moves that are $50 each throughout the process of it actually giving me the price correction to 402. But guess what? This stock sucks. It doesn't want to bounce at all, and it continues to time correct. Next 5-minute candle, it retraces down to a new low of 396. And then we get a bounce back to, just under 399. So same deal though. Like I bought down to 396, so now I get to sell 396.50, 397, 397.50, 398, 398.50. That's another $250 worth of sales. But time is not my friend. the ADMA is now continuing to work its way lower. By the 1525 candle, the ADMA is at 460. So now I've got the original 600 shares that I bought at 401 sitting at 406.50. Again, actually technically a little bit underneath 406.50 because I don't want to be sitting directly at the moving average. I like to front run the moving average a little bit, but let's just use the moving average to keep it simple. Now, if I get the bounce back to 460, now finally I get a little bit of a price correction. It's mainly been a time correction. I get a little bit of a price correction to 460. I will liquidate my position. I will take a 40-cent loss. I'll take a 40-cent loss on the original 600 shares that I bought. But the amount of 50-cent kicks I got along the way, honestly, still probably has me positive overall on the trade. A lot of work, a lot of risk, not a ton of reward for the risk that I'm getting, but still probably coming out positive on the trade. But guess what? This POS still won't give me that price correction. We get a whole nother move lower. And this, again, this is why smaller account, if you're doing this at 100 shares each, your entire account's blowing up by the time this thing is putting in its low at nearly 394.50. And then finally you get a bounce back to 398. You end up selling the ADMA here, finally get a touch of the ADMA at 398. You end up selling your original 600 shares that you bought at a $3 loss. So that's $1,800 of a loss right there. Plus, you bought 100 at 450 that you're selling at 398. So that's another $250 loss, plus the piece that you bought at 400 that you're selling at 398. That's another $200 loss, plus the 399.50 that you bought. It's another $150 loss, another $100 loss, another $50 loss. Most likely now, when you're liquidating this position, you're taking a loss on this position. Almost definitely. All those amount of kicks that you were able to get from those incremental movements, which weren't nothing. It's probably, I would assume, if you did 100 shares each, at least $1,000 worth of P&L, but you still took an $1,800 hit just on the first 600 shares alone, plus the other, whatever I just calculated, is probably an extra 300. You're probably taking like $2,100 worth of losses, and maybe you got like $1,000 or $1,500 worth of kicks, and then you're ending up with like a whatever $600 to $1,000 loser overall on the trade. If you traded it with the game plan that I referenced, if you did it on 100 share increments like I referenced, obviously you could do a different game plan. You could have done full $1 movements, or you could have done less than 100 shares potentially because it's an expensive stock. But that, I'm just using 50 cents and $100 100 shares as just like simplicity sake for this example. So the bottom line, to circle back to even what I was talking about with like the extension downside trade and like the RGTI and QUBT, where I said earlier, like I'll make money if I get a price correction. I'll make money if I get a time correction. I was referencing a time correction that stays around the price where I started buying it. I'll even make money if it goes against me, provided that the volatility is greater than the amount that it went down. And in this case that I just described to you, that was not the case. It went down by more than the volatility in the correction from where I started buying it. So that is the circumstance in which you end up taking a loss on the trade. And then where you can really do a lot of damage to yourself is if you get stubborn, and I've done this before. You get stubborn and you say, well, I created this game plan where I was going to liquidate on a touch of the ADMA, but now that it's actually touching the ADMA and I see that I'm down $1,000, I don't want to liquidate it. I want to see if I can get a bounce back to the 21 EMA. And then guess what happens? Bear flag continuation happens, and next thing you know, when you should have liquidated for that $600,000 loss per your game plan, now you're down $5,000 or $10,000 in it because you just got bear flag continuation and you decided you weren't going to follow the game plan that you created for yourself originally. Which is why, regardless of the strategy that you're implementing as a trader, the most important thing I think about trading is to follow the preset game plan that you created for yourself in that trade when you get into it. And it's particularly difficult to sometimes do that in a trade with this sort of game plan because you're not trading with a hard stop loss. It's much easier to be able to manage risk and say you're wrong and get out of the way when you're trading a hard stop loss, not when you're having like a declining, for lack of a better term, stop loss that's based on the moving average and what is pretty much a mathematical law that at some point that moving average will get touched. So I like your trade as long as you were patient on where the buy was on the more extreme extension there. You got to be very, very careful doing this if there's news, because news in particular we know is when extension can become more extended. I'm not saying that there was news in Tesla here. I don't think that there was. I just think it was the weakest one that was out there. But news in particular, if news had come out, that's where you could be buying at 401 and this thing doesn't stop and give a bounce until it's at 380, and again your account is entirely blown up. So it's like I've said in the past in some afternoon meetings recently, I'm trying to talk a lot more about both what I think is the theoretical right thing for traders to do, because that benefits everyone, that especially benefits the newer, smaller trader. But I also want to talk a little bit more about what I do in practice, which is a lot more of what we just discussed here, because that will help certain traders also. But just to repeat what I was saying earlier, this type of trade, this type of game plan is not for the entry-level, smaller account trader, because you will blow your account up, because to answer TT's question here, there is no stop loss. There is no stop loss. And I say that any trader who is working with a smaller account or is newer, is in their first year of trading, should never take a trade that does not have a stop loss that is defined the second that they enter the position. Because you, in my opinion, don't have a big enough of account, and you're not, and I'm not saying you directly, TT, I'm the general you, you don't have a big enough of account to be able to manage this properly. If I had like the worst case situation occur here, I ended up losing $10,000 in this, because here's another really bad situation that could potentially happen. You get involved in this trade because it's breaking lower, and then after you're in it, news comes out. How about that? I've had that happen to me too. You trade long enough, anything's going to happen. Any and everything will happen. It's already working its way down, and you're like, oh, look, I got a nice extension trade here in whatever stock or at the index or whatever. And then after you're already in it, working it, news hits. And then you're just like, oh my God, I'm down way more than I ever expected I would be in this off this game plan, because I got involved in a trade that I didn't think that there was news, and then news hit while I was in, and I just got completely screwed. Whereas if you just had a stop loss in and then news hits, your stop loss is going to trigger. You're going to lose the amount that you expected to lose anyway, and it didn't matter that the news hit. I mean, it sucked because it caused your trade to fail, but it didn't really add on any extra risk. So I hope that helps, Jim. Cool. Anybody else have anything for today? Yeah, no problem. Going once, going twice. Oh wait, hold on. I think I missed something from Mike Reed. In reference to your 50-cent increments, how do you determine what the increments will be for the ticker you're trading? That's a great question, and it's a difficult one. You need a balance between risk and movement, basically. If you choose an increment that's too wide, like if you wanted to do Tesla in $5 increments, well, guess what? Especially if you're just trying to take it as a day trade off this move here that Jim was involved in, maybe if it was a swing trade, it might work. But if you were doing Tesla in $5 increments or $10 increments, it's just nothing's going to happen, right? It's just going to be too wide. And again, I'm using an extreme example there. If you do Tesla in 10-cent increments, the amount of risk, if you start buying, 401 with a move to 404 and you want to do 10-cent increments, is another extreme example that borderline silly. You would be taking 3,000 shares to start with, 1,000 shares for every dollar because it's 10 cents. And by the time this thing gets to lows at 394.50, so that's another That's another $6.50 down. So that's another 6,500. You would have 9,500 shares of Tesla at that low, and you would be down like $1 billion. Not $1 billion, but like the tighter the increments are, the more risk it's going to be that you're putting on from a dollar amount if the thing continues to move against you. So you want to be able to find a balance on whatever stock or index or whatever it is that you're trading, where the movement will pay you because you're able to buy and sell and buy and sell and make money in that time correction, but not that it's so tight that you end up with 10,000 shares of Tesla that could continue to crater another $10 against you, and your entire account is blown up. So if anyone's newer to that, attempting this type of strategy, I would err to the side of being too wide than too tight. You're better off being like, oh man, this is so boring, nothing is happening, I'm not getting filled on my bids or offers, and learn from that, than doing it too tight and then finding you're down a boatload of money when the thing moves against you. So really, it's about finding that balance. And how do you determine what that right balance is tricky, because you need to know the stock that you're trading really well. I think you need to know how it moves, because again, not every $200 stock, to go back to Giancarlo's question from the YouTube from earlier, not every $200 stock is the same. A $200 stock that's Procter & Gamble is going to be very different than how it moves from a $2 stock a $200 stock that's Procter & Gamble is going to be very different from how it moves if a $200 stock was RGTI, right? Whereas if you do 50-cent increments on a $200 Procter & Gamble, maybe nothing happens. And if you did 50-cent increments on a $200 RGTI, it could be insanity, and your account's blown up. So it's really about trying to figure out that balance and knowing the stock that you're involved in. It's based on price and movement, really, and that's all I have to say about it, I guess. I'm trying to find like a better like rule that I could give you on like trying to figure out what it is, but I think it's so specific to the stock that you're doing. Like most of the time, if I'm doing that TQQQ, I do 25 cents. Every once in a while, if it's meant to be an aggressive day trade off of a 5-minute extension, I do 10 cents. The thing about doing 10 cents is that can become a lot real quick. I remember I was doing that on the long side. Was that Friday when University of Michigan hit? I think it was. I started buying TQQQ for like an extension bounce trade, if I remember correctly, and it bounced back, but never quite got to the ADMA, so I never fully liquidated it. And I was just doing these tight 10-cent increments, and then like an idiot, I didn't realize that we had University of Michigan coming out at 10 o'clock. It's entirely my fault. I probably would have traded it differently or not at all. And then all of a sudden, I went to being in the money and just about to liquidate my TQQQ to holy crap, this TQQQ just got smoked at the University of Michigan and just went from $77.30 to $75.23. And I was buying 100 shares every 10 cents and 100 shares every 25 cents. So basically 1,400 shares every dollar. So what's that? A move from 77.30 down to 75.25. So it's like a $2 move. So all of a sudden I found myself having like 3,000 shares of TQQQ at that point. And trading it super rapidly and briefly was decently out of the money. Then I got my price correction and I liquidated the position into the ADMA. I think I might have had a risk reward stop that triggered in front of the ADMA. And I ended up making money in it. I ended up making, probably not enough to justify the amount that I was down at lows, but that's the whole thing with this strategy, is that a lot of the times you don't get a lot of times you just kind of get a lot of singles and doubles out of it, where it's a higher hit rate, but not a huge amount of P&L necessarily for the risk that you put on. Like I feel like I made 1 for risking 4 on what I was down most on that. But I also feel like when I do that trade, most of the time the risk reward's better than making one while risking four. And two is even when I do that, I feel like I have a higher win rate. I probably have a 75% plus win rate on doing that, where I come out positive at the end of it. So even if I have a 75 plus win rate on it and I only make one for the four of what I was risking, that still kind of works out. um, but in actuality, I think that the risk reward most of the time when I put that trade on, it ends up being better than that and still has that degree of win rate. So the numbers end up really working out overall. It's not too often when I'm doing this, as long as I pick my spots properly. That's a big key to it, is really picking my spots properly on when I start. As long as I pick my spots properly on when I start, I fairly rarely get caught where I'm having what Jim had happened to him in NVIDIA today. And honestly, it sucks that you took a loss in that, but this was almost like the worst case scenario that could happen. And I think that that's not, to be clear, it's not the worst case scenario that can happen, but it's towards the worser case scenario. And I think that that's going to be relatively rare overall if you pick your spots properly on when you first enter it. And I am, to answer David L's question here, I'm pretty much 100% providing liquidity doing that, except for maybe sometimes on the first entry. Because think about it, right? Like going back to Jim's example on Tesla. So maybe on the first entry, I take liquidity. I say, all right, now's the time. I want in at 401, and I just take liquidity on that 600 shares. But then everything else is bids and offers. I immediately offer out all 600 shares all the way up to 400. I immediately bid out all the way back down. So every single order is a providing liquidity where I'm paid by the ECNs for providing that liquidity, and that helps also. It helps keep the cost down a little bit. All right, cool. After 5 o'clock here, or at least in New York it is. So I will wrap things up there. Have a great night, everybody. See you next time.